Welcome back to The Explainer. Let's just jump right into this, shall we? What if I told you there was a financial signal out there with a near perfect track record for predicting economic downturns? I know, it sounds like some kind of urban myth from Wall Street, but I promise you, it's very real. It's called the yield curve, and honestly, understanding it is kind of like having a sneak peek at the economic future. To really grasp just how powerful this indicator is, I want you to consider the number 9. According to research straight from the San Francisco Federal Reserve, this specific market signal has correctly preceded 9 out of 9 U.S. recessions between the years 1955 and 2018. 9 for 9. That is an absolutely flawless strike rate over a massive chunk of economic history. And the context behind its reliability is just incredible. I mean, in almost 70 years of tracking this metric, there has literally been only one single false alarm. That was way back in 1966. The signal flashed, the economy absolutely did slow down quite sharply, but a technical recession never officially arrived. Just one single miss in nearly 7 decades. So what exactly is this hyper-accurate indicator? Well, to answer that, we're going to need to strip away all the complex financial jargon. Section 1, Bonds Explained Simply. Okay, let's look at a really basic, everyday concept. Imagine you're loaning some cash to a friend. If they say, hey, I'll pay you back in exactly 1 month, you probably aren't too stressed about it, right? It's a super short amount of time, very little can actually go wrong. But if they say, yeah, I'm going to need this loan for 10 years, your risk goes way, way up. Over a whole decade, inflation could spike, their personal financial situation could dramatically change, literally anything could happen. So, to account for that massive increase in risk, you would naturally charge them a much higher interest rate. That basic human logic, that's about 80% of what you need to know to understand this whole topic. So here's the crucial point. Governments borrow money the exact same way you lend your friend by selling bonds. If we take all the different time frames they borrow for, starting from a quick 1-month loan all the way out to a 30-year commitment, and we plot those interest rates, or the yields, on a chart, we get what is formally known as the yield curve. Every single dot on this line is just a real tradable bond. Connecting them just gives us a simple visual representation of how much the government is being charged to borrow money over time. Now, out of all those dots stretching out over 30 years, we really only care about 2 of them, the 2-year yield and the 10-year yield. The 2-year yield is essentially the now. It's heavily influenced by the immediate actions of the central bank, the Federal Reserve, and whatever their current interest rates are. The 10-year yield, on the other hand, represents the future. It's basically reflecting what the broader market expects long-term economic growth and inflation to look like over the next decade. And when you compare those 2 specific data points, you get what financial professionals call the 2's-10 spread. It is simply the mathematical difference between the 10-year yield and the 2-year yield. You are directly comparing current conditions against future expectations. This spread is hands down the most quoted number in this entire topic, and it is absolutely the key to reading the market's mind. So, to actually read that spread, we have to look at the overall shape the curve makes. Which brings us to section 2, the 4 curve shapes. First up, we have the normal curve, which brilliantly illustrates what a healthy economy looks like. The 2-year short-term yield is low, and the 10-year long-term yield is high. This nice upward slope makes perfect sense based on that friend loan analogy we talked about earlier. You expect to get paid more interest to take on the risk of locking your money up for a longer period of time. It's totally normal. Next, we have your middle ground shapes. A flat curve happens during transition periods, basically when the market is genuinely unsure if economic growth is going to speed up or slow down, which causes short-term and long-term rates to just sort of clump together. Then we have a steep curve, where the gap between short and long rates is way larger than normal. We typically see this post-recession, right after central banks have aggressively slashed short-term rates to try and jumpstart a recovering economy. Oh, well, long-term rates stay higher because people expect growth to bounce back. But then we have the inverted curve. The 2-year short-term yield is actually high, and the 10-year long-term yield is low. This is completely backwards. It is exactly like your friend offering to pay you more interest for a 1-month loan than a 10-year loan. It defies all standard logic, and honestly, that's exactly why it makes global headlines. It only happens when something in the market is genuinely deeply unusual. So how on earth does this backwards situation actually happen in the real world? Let's look at section 3. Why the curve inverts. Okay, here are the step-by-step mechanics of this bizarre flip. Step 1. Inflation is running hot, so the Federal Reserve hikes up short-term interest rates to cool the economy down. Step 2, investors look at these high rates and place a bet. They bet that these rates will inevitably slow the economy down so much that the Fed will eventually have to cut rates to rescue economic growth. Step 3, because those investors expect rates to fall in the future, they rush to buy long-term bonds right now to lock in today's really attractive yields before they drop. Step 4, all that intense buying pressure on long-term bonds actually pushes their yields down, ultimately dropping them completely below the short-term rates. It's a massive tug of war, and it's won by the expectation of a future slowdown. The overarching concept here is incredibly crucial. The yield curve itself does not cause a recession. It's not some weapon damaging the economy. Instead, it's the bond market collectively, with literally trillions of dollars on the line, voting that current conditions simply cannot hold and that a slowdown is coming. It's an absolutely massive voting machine flashing a warning light. But there's a vital catch if you're trying to time the market with this thing, and it's all about lag. Recessions do not start the very day the curve inverts. For instance, in May 2019, the curve inverted, but the recession didn't hit until March 2020. That was a 10-month lag. Ahead of the massive 2008 financial crisis, the lag was roughly 22 months. So the takeaway here is that the signal is directionally reliable for sure, but it is not a stopwatch. Historically, the countdown timer from the very moment of inversion to the actual start of a recession can take anywhere from 6 to 24 months. It is an incredibly accurate reason for caution, just not a reason for immediate day-one panic. So with all that historical context established, let's bring this right into the present day to analyze what we're actually seeing right now. Section 4, the 2026 Economic Outlook. Bringing this right into the present day, we have an incredible plot twist for the current market. Back in mid-2022, a major inversion began, and it wasn't until late 2024 that the inversion finally ended. That is 27 continuous months. We have literally just exited the longest continuous yield curve inversion ever recorded in all of financial data. Let's look at the actual yields as of mid-July 2026. The 10-year yield sits at 4.55%. The 2-year yield sits just a bit lower at 4.17%. If we do the simple math there, that gives us a 2-10 spread of positive 0.38 percentage points. So technically speaking, the curve is no longer inverted. The long-term rate is officially back above the short-term rate. But wait, context really matters here, and we aren't totally out of the woods just yet. What we have right now is what you'd call a very narrow normal. A positive spread of just 0.38 points is extremely thin. It is nowhere near the healthy, robust gap of 1 to 1.5 percentage points that you typically expect to see in a strong, booming economic expansion. Just because it's technically positive doesn't mean it's acting like a fully healthy economy. The greatest thing about all this, though, is that you don't need some expensive Bloomberg terminal to follow it. I highly encourage you to keep an eye on this data yourself. It's so easy. Step 1, just go to investing.com. Step 2, search for U.S. 10-year Treasury yield and separately search U.S. 2-year Treasury yield. Or you can just search U.S. government bonds yield curve for the full visual chart. Step 3, simply compare the two numbers. If that 2-year number ever creeps higher than the 10-year number, you immediately know the curve is inverted again. Now, as you continue diving into this, remember this crucial takeaway. The yield curve is not a standalone crystal ball. It's a brilliant, highly accurate probability signal, but it's not a 100% certainty, and it absolutely cannot tell you how severe a coming slowdown might be. Professional investors always treat this as just one piece of a much larger macro puzzle, constantly pairing it with data on things like unemployment claims, credit spreads, and manufacturing output. Which brings us to our final, lingering question for 2026. With the absolute longest inversion in financial history entirely behind us, and only a fragile, super narrow positive curve existing today, is an economic slowdown still inevitable? Keep tracking the data, keep questioning the numbers, and you'll be exactly where you need to be to understand whatever the economic future holds. Thanks for joining this explainer, and I'll